What's going on, everyone? Over the last week, we have seen some wild changes in everything from housing to stocks to crypto and even employment. And I've got some big stories this week to go over and a lot of information in this week's market update. So let's get started. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida, and on this channel, I bring you the latest market news so you can make better decisions when it comes to buying, selling, and investing in Southwest Florida real estate. If you're new to the channel, welcome, and if you haven't already done so, please consider subscribing and hitting that bell so you don't miss out on the latest data, tips, and news keeping you ahead of the market trends. Well, over the last week, we've seen some pretty incredible drama in the stocks and huge shift in the housing, and a number of red flags indicating we may already be in a recession with more pain to come. And in today's market update, I'm going to address a number of scenarios that are unfolding very close to what I've been warning about and warning you all to keep an eye out for. This one is going to be packed with some important data showing where we may be heading, so let's not waste any time and start off with the 7-day local market data. All right, so in this week's 7-day market update, we went from new listings last week we're at 922. This week we're at 971. That is up 5%. Again, right in line with the trends we've been seeing, and now that is on a national scale. Listings are up, and I believe they're going to continue going up for the foreseeable future while buyer demand is waning. Solds 1161 last week, down to 910 this week. That's down 22%. The leading indicator, however, is the pendings, which went from 1184 last week to 1115 this week. That's down 15%. Quite a significant drop, and I think that's just goes along with all the trends of buyers just being priced out of the market and getting fed up with the prices. The big story here this week, we actually set a record for price decreases for our area since I've been keeping track of this over the last 2 years. Price decreases went from 539 last week, which was the second highest. Now we're at 606, which is now the number one highest decrease or number of decreases for listing prices. That's 12% increase from week over week. Moving on to the current inventory breakdown, single family homes went from 2758 last week to 3108 this week. That's a gain of 350 new listings on the market. So that's a huge gain. That beats all of our total gains for both single family and condos in the past by itself. So condos, we went from 1436 last week to 1554 this week. That's up 118 with a net total of 468 new listings on the market this week. That is double any of the listing increases that we have seen since I've been keeping track of this over the last 2 years. That's up from 238 last week, so that's almost 100% gain in new listings again this week. So that's just compounding. The surprising stat this week is multifamilies. We actually went up from 111, and now we're into 126. That's up 15. So that's a pretty significant number too, because for quite a while we were around the 68 to 70 multifamily properties on any given point in time, and now we're double that. So we are seeing listings coming back on. Foreclosures are up slightly this week, back to around the 36 range, which we were several weeks back. So we did get a few more this week. That's up from 29, so that's a gain of 7. All right, moving on to the interest rates for this week. As of today, the interest rates from NerdWallet went from 5.4 last week or last Monday to 5.3 this week. So that's actually down 10 basis points. Bank rate also had the average grow from 5.54 last week to 5.48 this week. That's down 6 basis points. So we did see a somewhat of a decline in the interest rates over the past week. Which is good news, but I don't think they're going to stay there for long. I do think that those interest rates will be rising very soon. So as some of you already know, over the last couple of months, I started working on 2 programs, one for buyers and one for sellers, to pretty much eliminate the issues with buying and selling, not only in this market, but no matter what market conditions come in the near future. So as we'll probably be seeing some kind of a market shift in the coming months. The buyer's program is called the Home Hunter Service, and the seller's program is the Home Sold Guaranteed program. I put a link in the description to check them out if you need to buy or sell in the next 6 to 12 months. And if you do, let me know your thoughts. All right, so let's get started with our headline stories this week. I have several of them. I'm going to go through these pretty quick because there is a lot of data, a lot of information this week, just with everything that's happened in the market and the markets, I should say. So let's start off with one that we've been tracking for a little while. If you guys remember one of my previous videos, we talked about the consumer debt starting to increase, and it increased quite dramatically in 1 month's time. This headline is consumer debt soared by 52 billion in March. So this is March. Now we're already in May, so we still are waiting for April. I'm assuming we're probably going to see this trend continue, but just from February to March, we went from 40 to 52. So that's 12 billion additional in 1 month's time. So consumer debt levels for March 2022 climbed to 52.4 billion, an annual increase of 14%. Revolving credit, which includes credit cards, obviously surged by 21.4%. And then, despite robust, they say, wage growth, which is 5.5%, where we have inflation at 8.5, that's actually you're losing 3% of your wage increases there. But the big thing here is with revolving credit surging and interest rates and the Fed tightening, the interest rates for credit cards have been going up quite significantly. So just from month to month, the interest that you're going to be paying on credit cards is going to spike. Now, if more and more people are putting a lot of their expenses on their credit cards, they're going to start to get overburdened with debt. That's a big issue. That's something that's going to take some time to play out, but that could be a potential problem for homeowners. I mean, just anybody really, for the economy in general, which is going to contribute to the recession that I believe is coming in the very near future, if we're not already in one. Um, Kind of going right on with that, actually, this story is something that I mentioned in one of my previous videos as hearsay. Now we actually have a story confirming one of the world's frothiest housing markets turned into a seller's headache overnight. So, where is that? It's in Canada. One of the world's bubbliest housing markets is tilting from sellers to buyers with dizzying speed. So, with those interest rate spikes, even in Canada, flipped the switch on Canada's white hot real estate market, spurring the first national home price decline in 2 years. So we're going to take a look at those numbers in a few minutes, but in some cases, people are turning to high interest bridge loans to get themselves out of tough situations. Does that sound familiar? Maybe not so much the bridge loans, but people were turning to alternative methods of refinancing and getting out of properties or mortgages so that they could get the properties in the first place. So, as we move on, some people who already bought new homes are struggling to offload their old ones. That's why they are turning to the alternative lenders where that bridge gap is there. Those who took out shorter term subprime mortgages, which account for 1.3%, and while 1.3% does not sound like a lot when you start to add that up into the total population of Canada, it does start to add up to a decent amount of homes. Now face the prospect of having to refinance at double the cost. So that could actually um, force sellers to sell or owners to sell, and potentially lead to distressed properties in the market. So that's something to keep an eye out on. And although it is only in Canada right now, I do think that we are going to see things like this starting to happen and moving south into the US. So here's a graph just to give you an idea of the home price declines, where they're at. There, some are fairly significant depending on the market. Kitchener-Waterloo down 8.4%, London 5%, 2%, 2.1%, and then obviously you have a couple that are still going up. But as you can see, the majority of it is on the decline side, which is going to continue shifting towards more of that in those other markets as we move forward with Fed tightening and how that's affecting the economies, not just in the US, but around the globe. So, April housing starts steady but single family drops. This is courtesy of Florida Realtors news site. Single family drops 7.3% due to a surge in multifamily production. The April reading of 1.72 million starts is the number of housing units builders would begin if development kept April's pace for the next 12 months. So that's something we'll have to see if that actually comes out when they do finalize the numbers. But single family starts decreased by 7.3%, and then you have the multifamily sector, which increased 15.3%. Builder optimism, right along with that story, builder optimism plummets in May. The confidence is down to 69 points in May. If you remember just a few months ago, I believe it was in January, when I first did the builder Optimism, they were at 92. So from 92 to 69 in just 3 to 4 months, that's a significant decrease. It's the fifth straight month for a decline, and in May, the lowest readings since June of 2020. So if that's the fifth straight month, then it must have been in November or December when I first reported it. All three HMI indices posted major losses in May. The one that gauges current sales conditions fell 8 points to 78. Sales expectations in the next 6 months dropped to 10 points to 63. And expectations charting traffic of prospective buyers, that's declined to 52. So they're not expecting very many buyers to be walking through their communities or coming through their communities. They don't to make expect to make as many sales, and then also the current selling conditions are also not great. I'm actually seeing a lot of new communities actually start to bring back some of the incentives, offering five, 10, $15,000 towards closing costs, or towards off the lot, things like that. So they're incentivizing purchases again, which means that they're obviously starting to see that they're not getting as many buyers coming through the doors. Also, mortgage applications decreased in the survey this week. This week, the mortgage application decrease was it was huge. It's down 11%, which is by far the largest decrease we've seen in the last 3 years. So 11% on a seasonally adjusted just from 1 week earlier. The refinance share of mortgage activity increased to 33%. Now, keep that in mind. If we've seen a huge 11% decrease in total applications and refinances are kind of just trickling in as they have been, it goes to show you that the refinances would gain a majority position because the rest of it has fallen off so much. So 33%, that's up just from 32%. So actually, refinances are probably down a bit. It just looks like they've gone up because they've gained a bigger share with a smaller total pool, basically, to pull from. FHA share of total applications increased 11.1% from 10.5%. I would say that this is probably due to people not being able to put down the full 20% because prices have been increasing. So if you're not able to put down the full 20% to get out of PMI, then at some point you might just say, hey, why don't we just put less down? We'll do an FHA. Or if you're at the 10% mark, we're able to put down 10%. You might not feel like you're able to as easily now. So you're going to drop down to a 3.5% FHA. That leaves you some cash left over to maybe make a better offer or close the gap between the appraisal if you need to do that as well. The VA share and USDA share of applications did not change over the last week. All right, report. So this was an interesting report that I found. It doesn't necessarily mean anything in particular, but I thought it was very interesting to see the numbers in here. Report: how many homes are sitting empty in your state? So I looked at a bunch of different states. This report: more than 16 million homes are sitting vacant across the U.S. according to this report, using census data. The study by LendingTree ranked the nation's 50 states by their shares of unoccupied homes. The highest vacancy rates were found in Vermont, Maine, and Alaska. That's also due just because of the population size. So the fact that you have less people in those areas makes it easier for those percentages to be higher, as you'll see in a minute. So the three states combined are home to more than 315,000 unoccupied units. As we move on, other states rank lower on the list but have many more vacant units because they're larger. Florida, for example, is number 6 on that list. About 17% of homes in Florida are vacant, which is approximately 1.7 million housing units just in Florida. But just to keep in mind, just because a house is vacant doesn't necessarily mean it's in ruins or is rotting away. It may be on the market, or it could be a vacant home, so a vacation home. So those factors do play a role in obviously those numbers that we're getting. But here's a look at the states on the left with the highest vacancy rates, and then the states on the right with the lowest vacancy rates. Florida is up there. Obviously, Vermont, Maine, and Alaska, as we mentioned, but Alabama is also a good size. Mississippi, Louisiana, those are all in the south. So it looks like those may be more vacation homes. But then on the right-hand side, you have the vacancy rates, obviously, are lower here. even California made this 8.7, but I'd say that's probably due to the amount of the size of the population there. All right, so the next story, Zillow, how far they've come. This is more of a just kind of a not necessarily a testament, but a testament to you know Zillow's actual data and how they're using their data or how they're reading their data. If we take a look at the first one, Zillow back in February, so this was February 22, they were giving their forecast for the next year. They expected annual home value growth to continue to accelerate through the spring, peaking 22% in May before gradually slowing to 17.8% by February. So they were looking at peak in May of 2020, 22%, which I don't think we hit. But from there on out, they're slowing to 17.8%. So now we're going to fast forward to May, which is 4 months later. May 19th, actually, as of today, Zillow's housing market outlook has been revised yet again. This is probably the third or fourth time they've revised it down now. From April, Zillow forecasts 11.6% home value growth over the next 12 months. I think they're going to have to keep revising this because I think it's going to go the other way at some point, like I had mentioned in the Canadian article there. All right, the wall of worry. We do have some revisions to this week. Fed rate hikes. So this is going to be huge because the Fed is starting to get nervous about the inflation. So there have been talks about possibly shocking the market. Raising 50 basis points another 3 to 4 times before the year's out. I'm not sure they're going to be able to get the rates that high, but if they do, all the power to them. Impending recession, job losses. That's a huge issue right now. We're already seeing tons of layoffs throughout the tech world, industry, but I think we're going to see those job losses extend into other markets and sectors. We also have the global shortages, baby formula, diesel, and wheat. Those are all commodities right now that are really under distress with supply chain issues as well as just not having enough already stored. So a lot of countries have started to cut back on exports, especially in food, but also in goods. So we'll have to see how that happens and see what happens with China now that they are starting to come out of their zero tolerance lockdown, I believe. Also, China-U.S. tensions over Taiwan. Taiwan is becoming a bigger issue now. China has been making some threats to U.S. to not interfere and basically stay out of the way. So that's obviously going to bring some issues with sanctions, which could, also trigger the supply chain issues and make inflation worse. But also war, which is costly, not only in just lives, but money as well, which, we already have plenty of money issues, I think, in our economy currently. Consumer credit and unemployment, distressed owners. Consumer credit is still skyrocketing. It's still going up quite a bit. And unfortunately, so are the interest payments on those cards as well. So I think this is something that we're going to have to look out for. And then unemployment numbers came out, and unemployment is ticking up. And I think that is going to only get larger and more pronounced as we move forward as well. So guys, keep in mind this is all of the data that I'm gathering, and it's my way of interpreting it. But I'd love to know what you think. Do you agree with what I'm saying? Do you think that things are going to head towards a deep recession, as a lot of people are predicting? A deep bear market. What do you think is actually going to happen with the housing market? Do you think things are going to kind of level out, or do you think we're overbuilding and we're probably going to be seeing price declines coming our way as well? I'd love to hear your feedback. Please leave those comments in the description in the comment section below. And like I said, check out that link if you're thinking about buying or selling in the next 6 to 12 months. Check out that link; it'll give you some great resources for either side of the transaction that will definitely be helpful for you as you move forward and start to make decisions on what you're going to be doing. So, but that's it for this week, and I look forward to seeing you guys in the next one.